Take a look at shares of Ryman Hospitality. The lodging REIT rising on yesterday's earnings report. They own both massive convention center resorts and a couple legendary concert venues. And their strength is coming from the return of corporate bookings, while leisure spend looks like it could be declining industry-wide. Here to explain in an Exchange exclusive interview is Ryman Hospitality President and CEO Mark Fioravanti. Mark, welcome to the show. Good to see you.
Good to see you. Thanks for having me, Kelly.
Yeah, I'm very familiar with Nashville, with the Grand Ole Opry. You've spent some time there in the past. I think we saw Vince Gill maybe. Anyway, it was
great
fantastic.
Artist.
Yeah, he was great. So, I don't know if Taylor Swift came through your venue, but can you speak to whether this kind of much hyped trend of spending on entertainment is something that you are seeing and is broad based, or what's going on with a little bit of this decline that you mentioned?
We are continuing to see broad-based spending across our businesses, both in the hotel business as well as entertainment. And on the hotel side, that is both in the group business, that our hotels are primarily large convention hotels with 70% of our business is group. We're seeing strong spending there, both in terms of rate and outside the room spending in areas like banqueting. And we're also seeing it on the leisure side. As we look into the fourth quarter, we're seeing solid leisure demand with our sales up, our pace of sales up in the fourth quarter over last year, which was a record for us.
Though some moderation with regular vacation rates declining, is that right?
Our leisure rates are holding up as well as outside the room spending. What we are seeing is a stronger growth trend coming out of the pandemic on the group side.
Absolutely. How much more does that room does that have to run? Kind of where are we compared with pre-pandemic levels, and how much further could that go?
Well, from a revenue perspective, in the third quarter, we were 39% ahead on revenue versus the third quarter of 2019. Profitability was up 44%. And as we look at our group business moving forward, our business on the books for 2024 is 10% ahead of where it was for the same time last year for this year, and we're up 12% for 2025 compared to the same time last year.
That's so interesting. So basically the corporate is back and your results are much better than they were pre-pandemic. Do you think that's sustainable?
We do. And the reason that we think it's sustainable is a couple of reasons. Number one, the pandemic, I think, made everyone realize that you have to bring people together, particularly large groups, if you want to talk about culture, strategy, product launches, et cetera. So coming out of the pandemic, there was a strong move back to bringing people together. I think the other issue that's driving some of our growth is that we've made significant investments in our properties since 2020. We looked at the pandemic as an opportunity to go on the offensive, and we've deployed approximately $1.7 billion in capital across both our businesses, whether that's enhancements, expansions, or acquisitions of new properties.
You have major complexes in San Antonio. I mentioned Nashville, obviously, Kissimmee, Florida, Grapevine, Texas, Aurora, Colorado, even in Maryland in National Harbor. So that CapEx is paying off. How much, though, are higher prices driving returns? And is that a trend that, where we're seeing some moderation?
Higher prices are driving returns. We are seeing, though, that business levels have returned to pre-pandemic levels in terms of the room nights sold. But part of the issue here, we think that the pricing is sustainable because we have invested in the properties. We've enhanced the product and we've enhanced the experience. And consumers look for value. They don't necessarily just look at price. And we think that we're delivering a terrific price value in both our businesses.